All right, everybody. So we'll go ahead and get started here. Don, I want to apologize if you hear any background noise. I'm actually out working on deploying your money here in the DLP Housing Fund. I'm actually in Oklahoma City right now. Been out on an acquisition walk, all due diligence all day today. And timing didn't work out as I thought it would in terms of my trip back. So Kyle's got the screen here. And I'm remote actually from the airport, about to head back to through Dallas to Florida. So bear with me if you hear any background noise. All right, so let's go ahead and dive in, Kyle. Go ahead to the next slide here. A little quick disclaimer. So DLP Housing Fund, as you guys have probably been paying attention to our emails, and if you've had any of our recent dinners, you've seen a bit about this new fund. We've been focusing on the launch of this fund over the last few months. It's a big deal. It's our 8th fund. It's a $1 billion evergreen hybrid REIT. And I'm going to explain what that all means here in a second. So for those of you who've been with us for a while, and maybe even those who've been doing due diligence on this for a little bit, you've probably been aware that we've run 2 different types of funds over the past 8+ years. We've run funds focused on our lending strategy, lending money to real estate investors, and then we've run multiple funds focused on investing directly in housing that we run and operate and manage. And this is the first ever fund that we've run that does both strategies, investing equity and making loans backed by housing, hence the name of the fund here, in one fund structure. And what we're told is the first really the fund of its kind that's ever been put in place. And we put this fund in place to be able to provide investors with all the benefits of both sides of our business. Traditionally, you've had to choose as an investor, do you want monthly distributions and liquidity, or do you want tax shelters and higher returns? You had to choose one or the other. And this fund allows you to get both benefits of both strategies: liquidity, monthly distributions, the highest returns, and tax shelters, all in one fund structure. So this fund is an evergreen style fund. That means it'll be open indefinitely. Meaning we're going to keep running this fund and growing as long as it makes sense for us to do so. It's a REIT structure. That's a tax designation that gives us some tax benefits that we'll talk about. Even though this is a brand new fund, the fund is actually already seeded with more than 4,000 apartments worth in total over actually $200 million. It's a portfolio of properties that we're currently in the preferred return equity fund, which has seeded this DLP housing fund. You get all the tax shelters of depreciation, just like investing directly in real estate or in any of our other funds. We're paying our monthly distributions. We're doing valuations of our portfolio every year and providing liquidity every year. So even though the fund's going to keep growing and go on indefinitely, you'd be able to get out of the fund at any point or at any year along the process that makes sense for you. For whatever reason, you say, hey, I want to get out. I think the real estate market's at its peak, and you want to exit the fund, you have that ability to do so, or stay in, allow it to grow in a tax-sheltered manner for years to come. So next slide, we'll kind of walk you through some of the stats. If you looked at any of our funds in the past, you've seen kind of this format. So you can kind of look at it in comparison to our other funds, such as the DLP Income and Growth or Lending Fund, and kind of compare it here. So I'll give you the highlights here. So this fund pays out monthly distributions each month of the preferred return, which is a 6% annualized return. So in other words, we pay out a 0.5% dividend every month. That 0.5% return or 6% annualized return is paid out before DLP even earns a management fee. And then the target return is generating at least a 12% return net to you, net of our fees. As many of you know, we've exceeded our return targets in all of our funds in every period. So very confident in being able to deliver and exceed that 12% annual net return target. And after we achieve our return targets, after we receive our preferred return, we get an 80-20 split. After we exceed the targeted return of 12%, it's a 60-40 split, 60 to you, 40 to us. Again, you can redeem out of this fund on an annual basis. You get the benefits of leverage. You can invest through qualified money IRAs, 401ks. You get the tax shelter of depreciation, as well as some other really tax advantageous structures here, which we'll talk about. This is a $1 billion fund. It's our biggest fund ever. This is our flagship fund, meaning this would be our biggest, our largest, our primary fund. And something I think really important to think about this fund is we don't go out and raise capital into a fund and then, I go invest my money and and we as DLP invest our money in other deals. We invest right alongside our investors, and actually right now in our real estate holdings, our real estate portfolio, which is around $700 million, I have over 40% ownership. So even though this is $1 billion fund, as this fund continues to grow, we will have a minimum of 5% of the committed capital invested as the manager. And right now, out of the gates, we have about 30% of the initial equity in this fund already. So we're investing right alongside you, incentivized and focused to generate the best returns and maximize the value of these assets. We have a great law firm, SEC attorneys, who helped us set this fund up and structure it, called Seward & Kissel out of New York. And we also have Cohen Resnick, the 8th largest accounting firm in the country, providing annual audited financials as well. And then we'll provide full reporting out to you as investors on the fund on a quarterly basis and on your statements on a monthly basis. And I'll recap that again at the end. So a quick bit about us here. I'll kind of move to the next slide. But this is our 8th fund, as I mentioned before. We've run all of our funds focused on investing in residential real estate. So this is nothing new for us. This is what we've been doing since 2006, is investing in residential real estate. We do so in two manners. One, by making direct loans to real estate investors, and second, investing directly in real estate holdings. That's where you see there on the screen. We do debt or lending investments plus equity investments, all in one hybrid fund structure that does both. So, and basically, in short, just about everything DLP does will be done in this fund structure. You see a bit about our story there. I'm not going to spend a lot of time on it, but again, started the company in 2006. We grew all the vertically integrated businesses that support this strategy, from construction to property management to our direct lending business to real estate brokerage, title, et cetera, over the years. That really puts a unique position that we are truly an operator, vertically integrated, and we handle all the execution of generating the returns that we pay out to our investors. Our newest business focus here is, last year we purchased Bright Homes, a home builder here in Florida, where we're building net zero homes, meaning homes with no energy bill, both for sale and for rent. And the homes that we're building for rent will actually go into the housing fund here. So it'll have a mix of multifamily communities that we focus on today, brand new single family rentals, as well as loans to real estate investors as well. There you see all the DLP companies that all work together to generate these returns and maximize these strategies, all under the DLP Real Estate Capital umbrella. And as I said a moment ago, we're vertically integrated. And what that just means is we do all the underlying work, all the property management, all the operations, all the asset management, all the construction management, all the lending due diligence and underwriting, servicing of the loans, all in-house. We have 360 team members here at DLP driving results, maximizing our returns. By doing so, we've had zero principal losses to investors ever, and we've actually exceeded our target returns in every fund in every period since inception, something we're very proud about. And the reason we've been able to do that is we run a very disciplined business here at DLP. Very soon, I'll be able to share out with all interested investors the book I just wrote called Building an Elite Organization, which is all about how we run DLP on our elite execution system, which is centered around discipline. Disciplined thought, which really means having a clear strategy, having disciplined people, and taking disciplined, consistent action each and every day. And by doing that, we've grown DLP by over 60% every year now for 14 years. And that's really why a big part of why our returns have been so consistent, because of the way we run our businesses. To that point, this will be now our 8th year. We actually just submitted last week to Inc. 5000 annual ranking. It'll be our 8th year in a row as one of the 5,000 fastest growing companies in America. Last year, we were the 5th fastest growing company out of all companies in all industries. And won lots of success for our growth and the type of company we run, including #1 workplace and fastest growing companies, top 10 real estate teams in America by the Wall Street Journal, et cetera. There's some stats on DLP today. I'll give you a little perspective. Over $850 million in assets. Last year, we did $119 million in annual revenue just from our operating businesses, providing housing to more than 20,000 people, and now over 360 team members here at DLP. So a quick bit about myself, as I mentioned before, I started the company 14 years ago, did not grow up in the business, although it is a family business. My mother, father, stepmother, stepfather, brother, sister, et cetera, all work in the business. Over the last 14 years, I've done over 14,000 real estate transactions, over $3 billion, including acquiring more than 15,000 homes and apartments. I'm also the proud father of two little boys there, Donnie and Alex, who are 6 and 7 years old, and my wonderful wife, Carla, coming up on 10 years of marriage. We live in St. Augustine, Florida most of the year, but also have a home in Bethlehem, Pennsylvania, where the company is still headquartered today, which you'll see in a moment. There's the amazing leadership team here at DLP. We also just this week welcomed a president of DLP Realty to the company, as well as a senior vice president of operations, two senior executives who just joined us here this week. Continue to build out the amazing leadership team that makes things happen here at DLP. This is a team that makes things happen specifically in managing your investment funds, getting your distributions out on time, managing all the accounting, providing you with service, coordination, hosting of our events, getting our reporting out, and so forth each and every day. And here's where we operate. As I said, we're still headquartered in Bethlehem, Pennsylvania. We're actually expanding our office right now, actually taking over another few thousand square feet of that building on the upper left there for our expanding team, about 120 team members in our headquarters. I'm located out of our St. Augustine Southeast headquarters there. We also have Bright Homes headquarters in Orlando, Florida. And then we have offices, a few more offices in Florida, as well as Asheville, North Carolina as well. This is where we do business, all those states in green, but we're heavy, as you'll see on the next slide here, in the Southeast, as well as in the Pennsylvania area. That's where we do the bulk of our investing. These are our apartment communities that we own today, where they're located. I'm out in Oklahoma City, as some of you heard earlier, out looking at a property here, which would be our second property in Oklahoma that we've acquired. All right, so our performance. So as I said earlier, we've exceeded our investment returns in all of our funds in 0 months of missing our return targets, 0 losses, double-digit returns to all equity investors in all funds. This gives you some overview on our historical performance, and we'll send this out. I saw a couple of people asking for recordings. Absolutely, we'll send this out. We'll also upload this video into the portal, and you can read over a lot of these stats. But the short version is we've generated great returns here over the years, exceeding targets in all of our funds. And this shows our overall returns each year across our funds if you blended them together. And these returns, especially these last couple of years, do not even recognize the returns that haven't yet been distributed because we only recognize or show returns once they're actually realized and distributed, meaning we've generated a lot of value in properties that we have not yet sold or in funds that we have not yet wound down in our equity funds. So we're not yet showing those returns, even though in many ways we've already done the work and increased the value in the assets. All right, so let's move into what we're doing with the capital here in the DLP Housing Fund. So first, we're making private loans to real estate investors. These are short-term bridge loans backed by housing. On average, 54% loan to value, 73% loan to cost, meaning there's 45% equity above our loan amount, a lot of skin invested, which I'll talk more about in a moment. We have 45 professionals running this investment strategy, directly originating loans to real estate investors, investors who are flipping homes, investors who are building a portfolio of single-family homes, investors who are buying and improving multifamily investments, investors who are building new houses. Essentially, we're lending to investors who are running the strategies that DLP runs directly on our equity side. We make short-term loans. When I say short-term, we're talking 6 to 12-month loans, first-position loans to bankable real estate investors. These are not loans to homeowners. These are loans to real estate investors. In fact, successful real estate investors who generally are bankable. Our average borrower that we lend money to has over a 700 credit score, has over $3 million net worth, $500,000 liquidity, and has completed more than 25 investments. So these are successful investors who are also personally guaranteeing these loans. We're making loans to properties, including single-family homes, as you see in those pictures, as well as apartment communities that you can see on those pictures. Again, same type of properties we buy, we operate, are the types of properties we're making loans on. So how we mitigate risk as a lender, first and foremost, is strong borrowers. You see some of the stats I read off there earlier. These are bankable borrowers, good credit, good net worth, a lot of liquidity, and a lot of experience, and they're personally guaranteeing the loans as well. The biggest thing of all in terms of how we mitigate risk from my perspective is where you see this as 73% loan to cost. That means our borrowers are putting 27% of their own money into both the purchase and the renovation of the property. That's a lot of skin in the game. That means that it's a $500,000 investment, they're putting about $150,000 of their own money into that property. Another way we mitigate risk is diversification. We have over 400 loans, which is growing each and every month, across 20 different states to more than 100 different borrowers. So diversification in location, diversification in a lot of different loans backed by different assets into a lot of different borrowers. In addition, we mitigate risk through DLP, the fact that we've flipped more than 1,200 homes. We've purchased more than 12,000 apartments. We currently and actively manage construction, property operations, asset management in many of the same markets we're lending in. And then we also mitigate risk by getting third-party appraisals and inspection reports, local inspectors and appraisers who have actually walk the properties, inspect them, give us detailed reports, value the properties, in addition to us doing all our own internal due diligence and evaluation as well. So here's an example of a house that we did a loan on. This is actually a higher-end house. This isn't our normal type of house we lend on, but this is a higher-end home in Tampa Bay to an experienced borrower. You can see what the house looked like when they bought it. It wasn't in bad shape. It just dated in a really, really desirable neighborhood. And this investor had already done multiple deals with us, actually done over $5 million in borrowing with us already. This was $1 million loan, 61% loan to value, 75% loan to cost. And this gentleman actually sold the property in 4 days for $225,000 more than we valued it at, which actually made our loan to value at about 55%. You see what he turned it into there at the end: professionally staged, high-end finishes, real incredible quality of construction and finish. And that's just an example of the type of borrower we work with and the type of quality they put into execution on these investments. So the other side of our investing is investing directly in real estate holdings, investing equity into purchasing and improving mainly apartment communities, primarily 200-plus unit apartment communities. Actually, the property I was at today is an 850-unit community here in Oklahoma City. Probably not surprised to hear that rentership is on the rise. We're in a rentership nation. Younger people are choosing to rent. Older people are choosing to rent. Actually, baby boomers are the biggest driver of the growth of people shifting from being homeowners to renters. People are starting their families later in life, buying homes later in life, getting married later in life, being renters longer. And again, many staying renters permanently are choosing not to be homeowners. We invest in the workforce, affordable housing sector. I mean, we're investing in properties that are affordable for the local population. That's often $700, $800, $900, $1,000 a month rents, where there's not enough supply to keep up with the demand. Cost of housing keeps going up drastically faster than incomes, creating a very big demand for affordable, safe housing in most markets across the country, especially these secondary and tertiary markets where we invest heavily in, where there hasn't been nearly the amount of growth of new housing product to keep up with the demand. Here, we invest heavily in the South, mainly the Southeast, but we've gone out, as I mentioned earlier. We're in Oklahoma right now. We've gone to Utah, to Arizona, Arkansas here over the last year or two, but still heavily focused here on the Southeast. But really the big key is we want to be in areas that have strong demand, strong population growth, strong job growth. The demand is the key to mitigating risk and maximizing our returns. You see some of the stats of what's going on in the market. I'm not going to read all those off for you now, but in short, the market is very strong. Rents continue to rise, home prices continue to rise. The demand continues to exceed supply in most markets. And really we expect here in 2020 to see very, very similar to what we've seen this past couple of years, which is consistent growth in cost of living in terms of rental rents as well as home prices. Very strong demand, meaning very high occupancies in our properties. So expecting 3 to 4% rent growth here in 2020. All right, so I'll show you a case study or two here in terms of properties we've executed our strategy. Because we're not just going out there, and we're not just going out there and buying properties and just managing them that are already well performing. We're coming in and buying properties and adding value. What we mean by that is we're coming in and renovating properties, drastically improving management, adding amenities, driving up rents, increasing occupancy, improving the tenant base, and a lot of heavy lifting in terms of renovation. So here's an example of a property we purchased in Brunswick, Georgia, 128-unit apartment community, and we bought it. 40 out of those 120 apartments had been down, unrented for 10-plus years. It was called Merritt Landing. We paid $5.25 million in 2017. We came in with a plan to renovate those 40 apartments, bring them available, improve the exterior of the community, improve and clean up the amenities, the landscaping, some roofing, and take it really from a C asset to a B asset. You'll see what these apartments look like when we bought them. 40 of them look just like that. They were gutted, and this is what we turned them into. We spent a little over $1 million on all the renovations of this property, and made 40 units look just like that. In addition to renovating a lot of the occupied units, we rebranded the community, improved its reputation, its management, the feel of residents really feeling like it was a great community. And we owned it for literally 24 months, almost to the day. We took rents from $652 to $818, which is about a 25% increase, but still very affordable. We took the monthly rental income from $53,000 to $100,000 per month. And because of that, we turned around and sold this property that we paid $5.25 million 2 years later for $9.75 million, generating an annualized IRR of about 30% net to investors. So that's a recent sale. Here's a recent acquisition. Actually, we just bought this property about a week and a half ago in Scotts Depot, West Virginia. A little bit higher class property, built in 2008, 2016, but still a great value opportunity here in that there's no other nice communities or nice housing available in this market, which is essentially Charleston, West Virginia. And so we're going to come in there and basically going to bring the 2008 construction apartment quality up to the quality of the 2016 apartments, and bring back online some amenities that are all flying at the community, and generate increased rent and increased resident experience, driving up the revenue here, and providing great cash flow to our investors in a really high quality asset here. So that's our newest acquisition. That fund will be in the housing fund here. Well, essentially it is in the housing fund now. It was purchased in the preferred return equity fund, which is now seeded the housing fund. So how we mitigate risk on this strategy? First is through a heavy due diligence process, hence why I'm out at a property right now. We spend a lot of time analyzing every deal we buy. We spend a ton of time analyzing the deal from a financial standpoint, going through all the leases, going through the rental income, looking at the other comparable properties, understanding the crime, understanding the local demographics, going out to the property, walking the competing properties, getting through every apartment, meeting the staff, really spending a lot of time making sure not only is it a property that we want to buy, but that it can hit our return profiles to our investors. So we buy very disciplined, meaning we're basically, in short, we're paying a much lower price than generally where properties are selling at or valued at today, and that creates much stronger both operating or cash flow returns as well as our overall return when we sell an asset. Of course, when you have a lower basis, we make very conservative assumptions what's going to happen in the real estate market, to still purchase assets that we expect to generate over a 20% annual IRR on the asset. We also put in long-term non-recourse debt, locking in our interest rates, sheltering from any interest rate fluctuations, and put on a lot of 30-year amortization, 10 to 12-year fixed-term agency debt on properties that we own. So with that said, I went through a lot of information pretty quick. I'm going to give you a bit of more information to recap on the housing fund, and then a couple of items on next steps. And then we're going to open it up here for you to type in or ask questions, and tackle any specific questions we didn't get into. So executive kind of highlight on the DLP housing fund. This is our first ever hybrid fund that does both debt and equity in one fund. It is our only fund that now invests equity in properties, the only fund that's buying real estate. In addition to the income and growth and lending fund, it'll be one of three funds that makes loans to real estate investors. The fund provides liquidity to investors. You can redeem out each year, monthly distributions. You get multiple different forms of tax shelters, including depreciation, including qualified business income deduction, which is on any ordinary income that the fund earns. From rental income, interest income is a 20% deduction in your tax bracket. And then on top of that, a lot of the income is sheltered from tax through depreciation. Target returns are at least a 12% net return to you as an investor in the fund. And the fund already has over 4,000, I believe it's now over 5,000 apartments already generating cash flow. So the fund will be producing cash flow, producing the 6% preferred return paid out monthly on day one of the fund, and it'll start making loans here within the next couple weeks. Has a strong acquisition pipeline already under contract as well to close. Here's a quick highlight once again: 12% plus targeted return, 6% plus paid out monthly. Everything over the 6% return will be paid out on an annual basis at the end of each year. We may choose later to pay out more frequent, but right now we're focusing on maximizing the returns and reinvesting the money throughout the year and distributing everything above the 6% return on an annual basis. And again, quick snapshot about us, our track record. All right, and then most of you know this already. I'm looking at the list of people on the call, but we have a new investor interface portal. You can access right from our main website, dlpcapitalpartners.com, top button, where it says Investor Portal. If you don't yet have a login, you can either set one up yourself or we'll set one up for you. The housing fund documents are being uploaded today, the final set of fund documents that, so you'll have those available to you. If you've been waiting for those, you can also do research on and get to know our other investment funds as well, such as the DLP Income and Growth and Lending Fund as well. All right, and then from here, other than asking questions here now, you may reach out to myself, Larry, Rich, Bob, and Mike, whoever you're already working with to follow up for additional questions that, for whatever reason, we don't get to today or you want to get into more on a one-on-one basis. So with that said, we're going to open it up to questions. Kyle, you guys can type those questions into the chat box, or if you're on social media on the chat box there or here in Zoom, and Kyle will shout those out to me, and I will start tackling questions. So thanks.
Awesome. Thanks, Don. So we have a bunch of questions came in. This one's from Niraj. It says, what kind of tax form will we get and how many state tax returns will we have to file?
Yeah, great questions. So as of now, you will get a K-1 partnership tax return, which has been, other than this past year with the DLP Lending Fund, has been the form of tax return all of our funds provide. We are working to see if there's going to be a way we can just produce a K-1 statement. I'm sorry, a 1099 statement. As of now, it'll be a K-1. Really the only difference to you is the 1099 returns come out end of January versus the K-1 take to middle of March. So Bob, our CFO, is still working with Cohen Resnick, our tax expert, to see if there's going to be a way we can distribute a 1099 statement. But as of now, we have to do a K-1 partnership statement. And then what was the second part of that question, Kyle?
Sure. And how many state tax returns will we have to file?
Good question. The expectation is that you won't have to file any state tax returns other than, of course, your own personal state return.
All right. We have another question here. This one comes from Charles. It says, I believe you've said that the share/unit value in the housing fund will be set at $1,000. Will that share/unit price remain at $1,000 during the life of the fund?
That's a great question. Thanks, Chuck. So yes, and yes. So yes, the unit price is $1,000 a share. What will actually happen in terms of the mechanics is, in addition to us paying out the realized returns, 6% preferred return paid monthly, and then all additional realized returns on an annual basis. So in addition to us paying out the actual realized returns, every year we will be conducting throughout the year, we'll be getting valuations done on the real estate we own, and we'll be producing an annual NAV valuation. Or in other words, we'll be finalizing what is the value of a share. So the expectation is the value of shares will increase over the course of the year as we are driving value and improving the value of our assets. So at the end of the year, when we figure out what the value is of the overall fund, we will actually distribute additional units to each investor. If the value went up, we're going to distribute additional units to investors. So kind of like a stock distribution, essentially. So if you had 100 shares today and the value went up 5%, we'll distribute to you another 5 shares. So Next year, you'd start the year off with 105 shares instead of 100 shares, but the share value would still be at $1,000. So it's like a stock split in a way. So to keep the value always at $1,000, we will actually distribute additional units to you when value goes up versus increasing the value of each unit. That way, if a new investor comes in next year, we've created mechanics to make it fair to that investor that he's coming in a year later. You have received that additional value in terms of you now have more units. And then if you chose to exit the fund, you'll be exiting out 105 shares versus 100 shares and realizing that increase in value if you redeem out of the fund. So hopefully that made good sense to you, Chuck, and happy to dive into more details on that if there's any follow-up questions on that.
All right, we've had a lot more come in. This one's from Jack, and actually I can answer this one. It says, unfortunately, I got on late. Will this be recorded to view later? And the answer is yes. It'll be on YouTube, Facebook, and the investor portal, and we will be able to send that to everyone that registered here for the webinar. And then we have one here from Barbara. It says, can we start out with smaller investments as we await other investments to pay out until we meet your minimum?
Yeah, I would say, Barbara, the short answer is likely yes. I would encourage you, talk with Mike or Bob or Larry, whoever you've worked with. If you're not working with anybody yet, you can go ahead and put that back in the chat box. And Larry's on as well, so he'll make sure if you're not already working with somebody, he'll get in touch with you, and he can talk to you about your specific situation and figure out, what makes sense for you in terms of, minimum investment. Sounds like you have some different liquidity events coming up. So short answer is I'm confident we can work with you on that schedule.
This is a follow-up from Barbara. It says, will K1 cause UBIT in self-directed accounts?
Good question. No. Short answer is no, for two reasons. One, the REIT designation eliminates any UBIT tax. Number two, UBIT, for those of you who aren't familiar with it, is when you invest via qualified money, such as an IRA, you can be subject to tax on income you make through leverage. And since we're borrowing leverage on properties, we have leverage that's where the question comes from, or the thought comes from. But we take out our leverage at a sub-entity level because each property we own is owned in a subsidiary entity. So that shelters any risk of UBIT as well as being a REIT. So short answer is no, and none of our funds, no investor has ever been subject to UBIT. But I guess I should, if Bob's on the meeting or Barry, our chief legal counsel, would probably tell me to tell you, consult with your tax expert. But we've never had an investor subject to UBIT, and the REIT structure eliminates that risk.
All right, we have one here from Jason. It says, does the DLP housing fund have a targeted breakout between multifamily and single family assets as a percentage of total AUM?
Yeah, that's a great question. And I'd say short answer is no. And same kind of question that we get often is, what's the target breakout between loans or equity? And we don't have an exact target there either. One of the great things about this fund is a couple great things for us and for you. Because the fund has the flexibility to invest in essentially whatever DLP invests in, it's going to help us handle the number one challenge we deal with today here at DLP Capital Partners, which is deployment of capital. Balancing the fact that we have loans paying off all the time, every day, and we don't usually get much notice to it. We have new investor capital coming in, all the time. We have, large acquisitions. We have a lot of money coming in and coming out. Our loans pay off really fast. A lot of liquidity, a lot of money moving, and it can be very challenging to manage that deployment. And that's the biggest factor that dictates our returns is how much cash we have sitting. So the fact that this fund has the flexibility to invest in whatever opportunity DLP has available that we invest in, any of our strategies, it allows us to better deploy the capital, which in turn will equate to better returns, and also is a great way, helps us mitigate risk ultimately in that we're going to invest, by nature and how we invest is we make decisions that we go through a very, very heavy process, detailed process for our investment decisioning, deal screening and credit committees, investment committees, and a lot of work. And if it turns out there's more deals that fit our return profile and risk profile that turn out to be loans versus equity this month or this quarter, we're going to have more loans. It turns out we have more investment opportunities that on the equity side, we're going to have more equity. And the same comment goes with single family versus multifamily. So if I had to look at the fund over the next 5 years and give you a guesstimate, my guesstimate would be it's going to be close to 50-50 loans versus equity, but it will be fluctuating all the time. And if I had to guess single family versus multifamily, I'd put a 60% towards multifamily, 40% towards single family. But those are, just guesstimates based on our current deal volume and our historical volume. But it'll change as market opportunities change and how we can go about generating the targeted returns while mitigating risk.
All right, so this one's from John. It says, it's hard to ignore current events of what we're seeing in this country with the virus. What are your thoughts of the present risks that exist based on this pandemic?
Yeah, it's interesting, interesting times for sure. I'm talking to you guys all from an airport right now. So far, I mean, I won't get too into, politics here on this webinar, but I'll comment that, for our world, one of the great things about our world is that stock fluctuations don't affect us in a direct manner. Indirect manner, there's lots of effects, such as, our phone rings per se, and investors want to move more money to us when the stock market's not doing well and there's turbulence going on. So from that standpoint, it's a good thing to us. But in terms of a direct manner, it doesn't play a big effect. The effects we've felt so far are not material effects, but they're short-term, logistical challenges. So the two main issues, we've seen, and they've already changed per se, is, a month ago when it was mainly in China, we dealt with some challenges and it didn't slow anything down, just caused us more logistical headaches to have to source materials that were coming over from suppliers from China, and things were delayed. So we had to, rush around to source certain materials. So caused some, logistical work for some of our team by having a delay. The challenge we're dealing with, over the last, that problem has now been since, at least for the moment, been resolved. There hasn't been any delays anymore the last number of weeks, but the challenge we're dealing with today is just the uncertainty for companies to know what to do with all the noise we're all hearing. So a lot of companies are putting kind of travel restrictions on their employees, and that's caused, again, some more logistical challenges. An example, we had a large contractor scheduled to meet us tomorrow out at a property to provide a bid on completing some capital work, some renovations on the property, and they canceled a day or two ago because their company has given them a travel restriction of no travel other than for a couple exceptions. So right now, I think a lot of people are just kind of don't know what to do. So and what approach take. So I think there's just some short-term logistical things like that we're dealing with. Same thing with the interest rate drop last week. Well, a lot of banks are kind of now, that was unexpected, I think, from just about everybody that was going to happen. So, now there's a lot of banks who are, just taking a few days here, a couple of weeks in some cases, of kind of pause to reset kind of the term we use in the industry is their spread, how much they are charging above LIBOR. It's just, again, caused some people have to take a moment to kind of pause and regroup. So it's caused a couple kind of short-term challenges such as that, but nothing material in that the fundamental investments we make are doing great. People need affordable housing to live in. It's not affecting jobs in major ways in any areas we've seen. Interest rates going down are overall a very good thing for us. So all in all, it's had no major effect, but just short-term kind of logistical challenges I just described.
All right, we have one here. It says, what is the planned schedule for the expected annual EDC at year end?
So right now, the target is to pay out the 6% preferred return on a monthly basis, as we talked about a little bit earlier. And then once a year, we'll finalize how much we earn. EDC stands for, those not familiar, excess distributable cash. That's how much cash we've actually realized. You know, basically what the returns we've realized, meaning we've actually earned and have recognized or realized in actual cash, not increase in value, but actually realized returns. So after we paid out that 6% on a monthly basis, at the end of the year, we'll finalize how much we earned above that 6%, and we'll pay out that additional returns in terms of EDC, into what we call EDC on an annual basis. At some point down the road, we could distribute more frequently, but right now we're not contemplating that, and we're intending to make the distribution the beginning of each year for the previous calendar year.
All right, I have a question here from Arthur. It's actually very similar to the question you just asked with the addition of this. It says, is the distribution of units at year end a taxable event?
No.
All right, so from Andrew, we have, what happens if someone, for instance, buys in November? Do they still get in at $1,000 a unit? Sorry.
Sorry, Kyle, I broke up there. Say it one more time.
Sure. It says, what happens if someone, for instance, buys in November? Do they still get in at $1,000 a unit?
Good question. Yes. So how it works is, it's a good question that leads to kind of a different answer, but yes, the price is always $1,000. The difference is that an investor comes in November, will only receive, so if they came in November 1st, they're going to receive, 60 days out of 365 days worth of the returns we realized that year. So as well as the additional shares that they would receive for the increase in NAV value I spoke about earlier. So in short, they'll come in $1,000, but they'll only realize 2 months worth of the increase in value and the returns we distribute versus receiving the returns for the whole year. Is how we've structured to make it simple, but also make it fair to any investor. Investor came in who was in all year long is going to receive 12 months worth of increase in value as well as distributions, while an investor comes in November will only receive 2 months worth.
All right, this one comes in from Bobby. It says, would DLP use the fund to purchase a property and also use the fund to rehab that same property?
So if I'm following the question correctly, so if we bought a property in the DLP housing fund, would the fund's money go into the purchase of the property and the renovation of the property? Yes, absolutely. So if the fund buys a property, say an apartment community for $10 million, and we have $1 million in improvements to put into that property and renovation of that property, the fund will put in a percentage of the $10 million to buy it and the $1 million to renovate it. The rest of the money will come from our loan that we take out.
All right.
And again, to comment, DLP invests a minimum of 5%, more often 20 to 50% of the capital and the equity into a property, alongside the fund.
All right, so we have one here from Chad. It says, long-term interest rates have very recently hit record lows. Has DLP been able to refinance any properties into these lower rates?
Yeah, it's a great question. So short answer is we haven't yet refinanced anything since the rate change a week or two ago. But we are absolutely in process of doing so. And there were some other pretty big changes as well that we're working to capitalize on. So one example would be HUD financing, which is the cheapest and really best financing, has removed some of the big restrictions that made it hard to use, such as you had to have a property fully stabilized own a property and have it fully stabilized for 3 years before you could take out HUD financing. They just removed that rule, meaning if we go and renovate a property this year, we can go and put HUD financing on it right away. We don't have to wait 3 years, which has been the rule for many, many years. So there's been some other changes such as that, in addition to lower rates, that absolutely have us working aggressively on capitalizing on these rates.
All right. So those of us in the pref fund were told that the unit price was increased from $1,000 to $1,070 around August 2019. Are we getting increased number of units based on this valuation?
Yes, absolutely. So your conversion into the investors in the preferred return equity fund, if they chose to, which almost all investors did, are converting into the housing fund. And so yes, if you owned 100 shares in the preferred return equity fund, you're going to end up owning, this is an exact math, but 107 shares in the housing fund as an example. So yes, absolutely, you'll get the benefit in the conversion over to the housing fund.
All right. This one is from Lee. It says, can you explain IRR? How does it compare with equity or income distribution?
Sure. So IRR, which stands for internal rate of return, is a calculation of what our annualized IRR is a calculation of what the annualized return was net to investors in terms of how when we talk about a 12% annual IRR. So that's the actual return that we distributed to investors on an annual basis. So we generally, or almost in every case, follow the XIRR calculation to how we calculate IRR. So you can go and Google and type in XIRR calculation and get a better kind of detailed overview than I can kind of give here quickly verbally. But short is it factors in time value of money to figure out what is a distribution. Like if we paid you out distributions a year from now, what is that return worth in a present value basis? So actually in pure dollars, if we generated a 12% annual IRR, we actually distributed to you quite a bit more than just a straight 12% on your money each year, especially if we look at it over a 5-year period or a 7-year period or a 10-year period. We have to calculate out the present value of money. So it's kind of a lot to get into here in this type of format, but if you look up how XIRR calculations work and you just type that in Google, you'll find some good overview, and Lee, and I'll also be happy to send you some information on that specifically as well to help walk you through it. But it's kind of a somewhat detailed formula that we use, and it's in our underwriting analysis we do on each deal we buy that calculates our annual IRR on each property we buy based on, again, kind of present value calculations.
All right, we have one here from Charles. It says, I recently watched a YouTube video by Nathan Trumpio made for prospective and current borrowers from DLP. So shout out to Talking Loudly with Nate. He indicated that DLP will be lowering its LTC parameters and its charged interest rates. Why is that?
Yeah, it's a great question. So the first primary answer to that question is that it's marketing. So that's the primary focus there is it's marketing. So in certain cases, for top tier borrowers, we've formalized some little bit better rates than what we would charge to an average borrower. We've already been doing that on a case-by-case basis that we end up negotiating with a big borrower. For example, if we're charging a guy who's flipping 10 homes a year, 11% interest rate, the guy comes to us who's doing 50 homes a year, we've, in many cases over the years, given him, say, 10% rate. So we've just kind of structured it a little bit more formal now as kind of a carrot to go after the best borrowers, something we were essentially already doing. In terms of the LTC, which is the loan to cost, again, it's very, very similar. We have not actually increased our max leverage we provide, and do not expect any change to our average LTC we provide. So again, we've had some different situations on a case-by-case type structuring for certain types of loans that we've done for substantial borrowers, that we just kind of formalize that in certain situations they could end up getting a little bit better leverage than what they would think by just looking at our website or our general terms. But there'll be no actual substantial change to our rates or to our leverage than what we're offering today.
All right, this is another question from Charles. It says, will there be fractional shares distributed?
So his question references, I believe, when we distribute out additional units for the increase in value, it could work out to be a fractional number of shares that it works out to be. And the answer is yes, is the short answer.
All right, we have a follow-up here from Niraj. It says, can you clarify what the minimum investment amount is?
So the minimum investment is $250,000. If you're an existing investor with us already, we do generally look at you as kind of as a whole in terms of all your investments with us. So in short, if you're an existing investor, we can look at, or if you're looking to be a prospective investor and you maybe want to diversify across, multiple different funds, we can look at doing lower than the stated minimums if you're diversifying and doing multiple investments with us.
All right, we have a couple more here that we'll have time to get to. This one is from, it's a two-parter from Matt and Kristen. It says, when will this housing fund go live for preferred return investors with the conversion?
So for preferred return investors, it's been live, meaning you're been in the housing fund since January 1st, but you've had the option until you got all the final documents and information. You have the option to elect out if you chose not to. But otherwise, it'll be, from a taxable standpoint, it'll be as of January 1 of this year. In terms of the fund actually being live and that we're taking in new investments, what we've been working on is getting all the final, a lot of kind of complicated final details with bringing over the funds from the preferred return equity fund and launching this fund structure. So fund documents are literally being launched onto the portal today, and are going to be going out individually to investors who've been asking for them, waiting for them as well via email here this week. So in short, this week we'll be live and start. We already have lots of investments already committed that we've just been waiting for the final subscription documents. We'll start taking those investments in. So that'll start happening, if not this week, by early next week, that we'll start taking in new capital. So in really short answer to that question is we are now essentially live, and we'll be having new capital coming in from new investors, meaning new to the housing fund, over the next few days. And the preferred return equity investors will get the copy of the final doc to make your final election that you want to be in the housing fund. In your case, Matt.
And I think you basically answered this one, but just for clarity's sake, this is the follow-up from Matt and Kristen. It says, will this go retroactive to January as we were informed? In other words, receive a full 12 months for 2020 returns?
Yes. All the underlying assets have been generating returns and cash flow since January 1st. So yes, you will be receiving those returns since January 1st. Absolutely.
All right, we have two final questions here before we have to get off, but if anyone has any follow-ups, reach out to info@dlpcapitalpartners.com or any of the investor success managers you work with. This one is asking about the long-term rental program. Can you explain a little bit about that, and does it interact with this fund?
Yes, it's a good question. So again, if you're on kind of our direct lending partners, emails or monitor social media, like Chuck mentioned earlier, you may see that we have a 30-year amortization rental loan program. So a program that people who want to, in general, this is how most of our investors work. They buy a distressed home, they renovate it, and then if they want to hold on to it and rent it and keep it, we have a 30-year rental program that they can go into a 30-year mortgage at traditional bank-like interest rates versus, the average interest rates that we charge today on short-term loans at 10.3%. So the positive of this is it's a exit for our funds because we're able to refinance people out of our short-term loan, providing an exit and into a permanent loan. That does not interact with these funds in any direct way other than providing an exit. Direct lending partners is actually in essentially brokering those loans to a large capital partner who wants to balance sheet, 5 to 6% interest rate type 30-year amortization mortgages that doesn't fit the return or risk profile of our current funds. So it's just providing an exit to our short-term loans that we make today.
All right, we have one here. It says, can you clarify how the capital call works and if money is called / invested in the full amount right away?
Yeah, it's a good question. So generally in all of our funds, historically, we have not operated a capital call structure, which means you have $500,000 you want to invest. Whenever you sign the paperwork, you can wire or ACH or give us a check, and we take in that money right away. And it goes into a subscription or escrow, essentially bank account, until such time as we're able to deploy it, and that's when you start earning returns. A capital call structure, for those who are not familiar, is a structure where you sign all the fund documents, but you wouldn't send the money in until we're ready to use the money, and then we would give you generally a 15-day notice when we need the money so that you can then prepare and send us the money. So we can do a capital call structure here in the housing fund if that's something an investor would like to do. And basically, if you sign the paperwork today, make your commitment, you'll hold your place in the deployment line, meaning you'll be deployed before an investor who signs their paperwork tomorrow and wires the money in right then and there, because you already signed and committed, but then you're obligated to fund within the generally 14 or 15 day, I can't remember if we did 14 or 15 days, but the 14 or 15 day deadline. So if that's a preference to you because your money's working somewhere else, earning some level of return, and you'd rather hold on to it until the day until we need it, you'll be able to do that here in the housing fund.
All right. I think we have time for this one last question. And again, if you have any follow-ups, info@dlpcapitalpartners.com. This one's from Andrew. It says, on those extra 7 shares coming over from preferred, that will show up as capital gain or as ordinary income when it's cashed out?
So it's not a taxable event. That's a short answer. So you're transferring your interest from one partnership, the preferred return equity fund, to another partnership, the housing fund. So it's not a taxable event. It's a good question, but yeah, it's not a taxable event. All right, so is that all the questions?
Yes, I think that is all the questions that came in.
All right, awesome. Well, that was a great set of questions, everybody. Appreciate it. Hopefully you're half as excited as I am about this fund. Then that means you're pretty darn excited. So again, reach out to whoever you're working with, send your or you can email directly to the emails that you get from us. We'd love to follow up with you, discuss this further. And my last kind of point here is we have an incredible deal volume right now of deals that are closing that the housing fund will be investing in. So in really short, I can tell you for the next immediate future here, the next 30, 45 days, money that comes into the housing fund is going to deploy extremely quickly within days, at most a couple weeks, depending on when the next property we're buying is closing. But money's going to deploy very fast. So it's a great time to get in because we have no doubt we have a number of large pension funds completing their due diligence right now who are making sizable investments into this fund. So that we will have, I won't say a capital deployment challenge, but we'll have a lot of capital coming in here as we get these documents out to a lot of groups who've been waiting to be able to move forward and make commitments. So if you're interested in doing so, I encourage you to follow up quickly. And if you want to get your money deployed quick, this is a great time to do so. All right. Well, thank you, everybody. Appreciate it. Have a great rest of the evening.